Um, as always, to start out, the most important thing is to express our appreciation for you being our clients. Everybody in this room I actually know, and you make our lives very interesting, and we appreciate that very much. And you give us an opportunity to serve. And you know what's very remarkable is that we get to work, I think, with some of the best people in the city. Some of the most caring and thoughtful people. So we try to be the reflection of that. And it's not always easy, but we appreciate you very much. Tonight, we have our quarterly gathering. Seth Meisler giving us a update on the investment world. And he did a great job at noon today. So I'm expecting actually even more wonderful things. But it was about a half an hour worth of listening to Seth tell some stories, to give you some thoughts about what has happened, what might happen, and then we'll open it up to questions and answers. So thank you very much for coming. Oh, you don't need it.
Thank you, Steve. So this is the second quarterly, what we're calling either a coffee or a chat that we've had before. The idea is to do something like this every quarter, not necessarily every quarter talking about the economy. Some of it could be talking about taxes and tax changes that have happened, or tax strategies, other financial planning and retirement strategies, or technology. How best to use some of the technology tools that we have, or new technology tools that we have. This being the end of the year, and end of 2014, beginning of 2015, obviously very fitting to talk about what's happened in 2014 as well as what we foresee in 2015. Before I start, I'm kind of reminded, you can imagine Paris 1910, and the economic ministers are meeting to figure out how to plan for what's happening in France. And they turn to one person, they say, well, what do you think? And so that person says, well, I think in 5 years we're going to have a world war. It's going to be a land war. Millions of people are going to die. That's going to cause a redrawing of maps in the Middle East, followed by hyperinflation and another war. I'm sure that in 1910, they would look at that person and think that he was absolutely crazy. So whatever the moral of that story is, to have a little bit of humility when we're looking at what's going on and what the impacts of what's going on. Because certainly, just in 2014 alone, there have been a number of surprises that absolutely no one, at least that I've seen or read, really predicted what would happen. Specifically, the drop in oil of about a 50% drop in about a 6-month time period. So with that level of humility, we'll go and review what happened over the year and what things look like. Again, we're going to look at 2014, specifically the fourth quarter, of what happened, what we think is going to happen in 2015, and also how do we react to what we think is going to happen in 2015. We're going to focus on the economy. We're also going to focus on the stock market. The two are different. There's certainly overlap between the two, but they are different things. We're also going to look at bonds and interest rates, specifically U.S. bonds and international bonds. Even since putting this PowerPoint together, and it was put together several weeks ago, quite a bit has happened in the major economies. Specifically, the two major things are that as of last week, Europe officially announced that they're doing some form of quantitative easing. And when we talk about quantitative easing, it means that they're buying bonds. The central bank, European Central Bank, is buying bonds on the open market. And what exactly does that mean? And the second thing that's happened is that Switzerland has separated the Swiss franc from the euro. And so, and that's had a number of repercussions. If you wanted to buy a 10-year Swiss bond today, how much do you think you would receive in interest? Minus 0.3. So effectively, you would be paying the Swiss government to hold your money for 10 years. of which you would not receive 100% of what you got. That is what the market has, and we'll see how the ramifications of something like that. Some of the surprises for 2014: we had Ebola, we had Russia invading Ukraine, we had oil prices, interest rates, and we're going to talk a lot about interest rates. Japanese started their quantitative easing, and they're doing something a little bit different. The Japanese pension fund is buying bonds and stocks. So that's something different than other countries really tried to do. And strength of the U.S. dollar. I think that's something that's been underreported, but we're going to talk about it quite a bit, because I think that was another surprise, the level of the rise in the U.S. dollar, especially when quantitative easing from the U.S., when the U.S. stops its bond buying, that the dollar really rallied very strongly. Okay, so how was 2014? 2014 returns for the S&P 500, so the 500 largest U.S. companies, were quite good, 13.69%. That's significantly higher than average long-term returns for the U.S. stock market. S&P 500 is about 8. The size of the company changed the return dramatically. So large companies, as marked for the S&P 500, is 13.69. Mid-sized U.S. companies was closer to 8. Small companies was 4. So depending on the size of the company, quite a big spread in returns in the U.S. How about outside the U.S.? International developed, minus 7.3. International emerging markets was minus 4.6. So quite a big difference there. Finally, in the bond world, what was safest did best, and what was long-term did best as well. At the beginning of 2013, Bloomberg asked a bunch of economists, what do you think is going to happen to interest rates? At the time, about 86% said that interest rates were going to go up. That clearly did not happen. And so Barclays Aggregate Bond Index did the best, and in the bond world, 5.97%. High yield, so taking on more credit risk, did significantly worse, especially in what we call bond terms, at 2.45%. International bonds did even worse at that, at 0.5%. The worst performer, far and away, was commodities. Minus 24% return for commodities. Oil was down 47%, but oil was not the only commodity that was down. Copper, cotton, gold, really almost any commodity was significantly down for 2014. What about volatility? We had 2 corrections in 2014. The corrections were relatively modest. And when I say relatively modest, I mean from September to October, there was a minus 7.4% correction that was rebounded very quickly after the Federal Reserve announced that they were holding back on the timing of doing any changes in interest rates. And then we had one in December that was minus 5%. And again, when there was more announcements of additional central bank, what I would say, intervention in the marketplace, there was some rebound in those markets. The last time we had what we would call a true correction in the market, let's say a true correction being a 10% correction or more, was 2011. So 2011 was the last correction. By and large, volatility in the S&P 500 has been relatively benign. It's been a relatively smooth ride over the last 3 years. One thing we think is that that may change, that level of volatility. Okay, so how about the U.S. economy? We'll talk about the U.S. economy. What we're seeing is continued growth in the economy. We're seeing an improving unemployment situation. So the employment situation is a little better, and we'll see some slides looking at that. Seeing an end of quantitative easing. So the Federal Reserve, the central bank, has stopped buying new bonds. And we've seen a shift in the White House. Or not shift in the White House, a shift in Congress with a Republican-controlled Congress and Senate and Democratic president. We've also seen 2014 is the first time we're seeing now really that the kick-in of the new tax rates. These were tax rates by the Affordable Care Act. Those tax rates are 3.8% capital gains tax for incomes above $250,000, as well as not a tax by loss of deductions. So in other words, tax rates didn't necessarily change, but by certain loss of deductions, your tax is effectively going up. So the U.S. economy, we have third quarter data. We don't have fourth quarter data yet. But third quarter, the U.S. economy improved by 2.7% versus for the quarter. Long-term average for the U.S. economy is about 3%. So we're getting much closer to average. So since 2009, we've never hit that 3% number really. Compared to a year ago, an improvement of about 5%. So certainly decent improvement, decent movement in the U.S. economy. Moving forward, it's not gangbusters, but it's certainly a forward movement in the economy. I do want to point out on the right side what the makeup of the U.S. economy. 68% of the economy is consumption. So we are everyone says we are a consumer-based economy. That's definitely true. I also want to point out net exports is minus 3%. So that's exports minus imports. One thing the Federal Reserve is looking at is that they say that the U.S. economy is a relatively closed economy. And what do we mean? What we mean is, or what do they mean? They mean that overall, what happens in the U.S. stays in the U.S., and they're less worried about what's happening outside of the U.S. unless it comes back to impact the U.S. And so what we're beginning to see is that what the U.S. central bank policy is doing is different than what other bank policies are doing. So where it was more coordinated around 2008, 2009, we're beginning to see kind of central banks moving in different directions, at different paces. Okay, let's talk about wages for a second. Unemployment right now is 5.8%. That is the best it's been since 2009. 2009, unemployment was up to 10%. So overall, the employment picture looks a lot better. Minneapolis, you want to know what the unemployment rate is? 3, I saw 3.6, but significantly better than outside of the rest of the nation. So what's bothering the Federal Reserve if unemployment is so good, especially what's bothering our current Fed president, Coach Lakota? And there are two issues that he's concerned about, that he's brought up. He's been the dissenting opinion among the Federal Reserve. He's been promoting that the central bank does not raise rates and continues its quantitative easing, and he's been the dissenting, kind of the lone voice. But his big issue is two things. One is this number over here, which is growth in wages. So even though unemployment has gone down, wage growth really hasn't gone up. And so that's been a concern because that really is a sign of a healthier economy and also a sign of inflation. Right? The Fed has two mandates. The Federal Reserve is responsible for two things. One is inflation, and they have a target rate of 2% inflation. And why is really unimportant for this conversation, but that's really what they're trying to do. The second thing is employment. They are responsible for making sure that the U.S. economy has full employment. So the fact that they haven't seen significant wage growth leads to inflation, and they really haven't seen, they haven't gotten to a point where we've seen a growth in wages that would lead to inflation. The second issue is this chart over here on the right-hand side, and that's what's called the labor force participation rate. In other words, what's happening is that people are dropping out of the job search. And the way that they measure unemployment is how many people are looking for work. If less people are looking for work, then the unemployment number looks better, even though there may not necessarily be more people working. And part of it is how the Fed, or how the statistics are measured. Some of it is going to make sense, and that's the big baby boomers retiring. As the baby boomers retire, the labor participation rate of the U.S. economy is going to shrink. So that will happen, and that's expected to happen. But what we're seeing here, this fairly steep drop-off in the labor participation rate is far greater than simply the baby boomers retiring. And so that's been the concern from our Federal Reserve President in terms of what's going on in the wages and why the unemployment rate of 5.8%, they basically don't feel that that unemployment rate is necessarily a true reflection of what's happening in the economy. And we can see on the chart on the left-hand side, 8.8 million jobs were lost in 2009. It was part of the recession. And since there, we've actually gained 10.10 million jobs. So we have had a net job gain since the recession. The problem is, this is over a 7-year period, number one. And number two, it doesn't account for the fact that the population in the United States has grown as well. So we've also had this growing population, and the number of jobs has not necessarily kept pace with the population growth. International-wise, it's a much different story. In terms of, we have slow growth. Internationally, it's more like no growth. So it's a much different situation. Europe is basically on the verge of some sort of recession. Prices are dropping, so they're experiencing deflationary pressures. And Russia is in even worse shape. So in other different countries, why? Primarily because they're oil exporting nation, and their primary source of revenue just dropped in half. We're seeing high unemployment, continuous high unemployment. So we're talking about like 25% unemployment in Spain. I mean, just big, big problems. And so we're beginning to see how the Federal Reserve, how the European Central Bank, the Japanese Central Bank, are basically changing policy. So in other words, whatever policy that they were doing didn't seem to work. They weren't, originally everyone was kind of following the same policy, then they went more, they changed their policy and tried to be more restrictive. That did not seem to work. They're now trying to do something different. One of the things that may happen is, what we may see is that this may be a battle of currencies. In other words, central banks may be trying to adjust their currencies and basically trying to deflate their currencies. Why would they do that? Because deflating the currency is really good when you're exporting, right? So if you're trying to pick up your country's economy, you can export more goods. That's great to deflate the economy. That may have happened in the U.S. That may have been one of the side benefits of the U.S. Central Bank quantitative easing. And when the U.S. Central Bank stopped with doing the quantitative easing, and Japan and Europe started their own version, now what we're seeing is basically a rise in the U.S. dollar and a decrease in other foreign currencies. So in the last 6 months, we'll get to what's going on in the U.S. dollar. Just again, another slide just showing the blue line here is the U.S., and you can see basically the economic growth of the U.S. and just how significantly greater it is compared to other countries. Japan, still not past the 0 point in terms of growth since 2007. Eurozone periphery, so this would be like Greece, for example, significantly negative over, again, a really long time period. So just no growth, and that's why, again, Greece is in the news once again. What about interest rates? So how is this impacting interest rates? What we're seeing is really significant differences in interest rates between countries. So we're talking about Swiss 10-year bonds being minus 0.3. German 10-year bonds, 0.5%. So that compares to our 10-year bonds, which are currently 2.2, I believe. So we're at 2.2. In the last 4 weeks, our 10-year bond rate has dropped by about 0.5%. So a fairly significant drop in interest rates in U.S. bonds. So if you're BMW, what are you going to do? The first thing you're going to do is you're going to issue bonds, and which is what they did in 2014. And so 10-year bonds that BMW issued was 0.5%. By the way, their stock, if you bought BMW stock, the dividend yield is about 3. Those bonds were sold out. Now, if you're a German company or you're a country and you're going to buy bonds, what bonds are you going to buy? Probably the U.S., right? Why buy U.S. bonds? Because the interest rate is so much higher than outside of the U.S. and you have currency appreciation as well. So you have stable country, you have increase in currency, and you have a higher rate of interest. That is currently what's happening, and about 40% of our treasury bond purchases are from outside the United States. Our opinion is that is going to put continued pressure on the interest rates in the United States. And so our opinion is that interest rates in the United States are going down. They're going to continue. Even though they are really low right now, they're going to get lower. You say, okay, well, how's that possible? And what we want to show on this slide is that we've had periods of time, I mean really long periods of time, where interest rates have been relatively low. We're talking about 30-year time periods. Now, I have no idea if it's going to be 30 years. I doubt it. I doubt that's the case. But all along we've been saying interest rates are going to be low and go lower, and we think that this is going to continue. At some point, it's going to end. I don't know when, but right now, all the direction seems to be the continued pressure on U.S. interest rates. Okay, so we've kind of put the framework of what we've seen in 2014, what we've seen in the economy, both U.S. and international. We've seen the stock markets, how the different stock markets have done, and we talked about interest rates, both U.S. and abroad. So the question is, what do we think is going to happen in 2015, and how is that going to impact the markets in 2015, as well as how are we positioning ourselves for what's happening? So in our opinion, economically, what we think is, and this is from Bloomberg, but we're looking at what we think is more likely than not is growth. So growth in the United States and growth abroad. In other words, what we're, I would say, somewhat hopeful for is that some of the quantitative easing works and that we see more of a pickup in growth outside of the United States. And the United States is continuing just doing what it's doing and will continue that growth. And this is not spectacular growth, by the way, but it's not bad either. Stock market-wise, what we're seeing is a U.S. stock market that is fair to slightly expensive. So it's a slightly expensive stock market. About 15 to 16 has been the average price for earnings level. So it's a little bit more expensive than normal, but not horribly expensive. As a point of comparison, in 2000, the stock market P/E ratio, price over earnings ratio, is about 30 times. So we're nowhere near those levels, but we should know where things are. International stocks are cheap. For the last 5 years, U.S. stocks have significantly outperformed the international stocks, and they're downright cheap. Now the question is, how do we measure the growth rate of international companies when the growth rate of the countries has been basically flat to zero? So the metrics that we have to look at international companies, we're thinking is going to be different than how it is that we look at U.S. companies in terms of growth. And so based on those differing metrics, they're still cheap, but they're not as cheap as one would expect. This slide here, what I want to show is basically U.S. earnings. And again, when we look at price, we expect that earnings is going to go up, and as earnings go up, the price of stocks will go up. And what you see here is earnings in 2013, 14, and expected earnings in 2015. And each year, the earnings of the companies that make up the S&P 500, the 500 largest companies in the United States, continues to go up. What you also see is basically this downward slope. That downward slope is that estimated earnings of companies starts up fairly high, and as the actual earnings comes in, it's a little bit less. So kind of optimistic forecasts and then get brought down. But But it's still relatively, I mean, it's not that steep of a slope in terms of what the forecasts are, what they are today. So just another point that seems to indicate that continued growth in the United States based upon continued earnings. And again, just another slide looking at various metrics of the U.S. stock market compared to historical averages. And overall, it doesn't appear, it appears, again, fairly priced, a little bit more expensive, but not bad at all. So what could go wrong with the picture of a growing U.S. stock market? We think that we may see increased volatility. So we think there could be more corrections in the stock market. But why do we think there could be more corrections? Primarily because of different central banks doing different things at the same time, and that creates uncertainty. And the market does not like uncertainty. So we think that could be a problem. In addition, the Federal Reserve has come out and said that they are planning on raising rates. They have not said when. They've said patience is needed, but the expectation is probably in the third quarter or fourth quarter of 2015. Our opinion is that generally, historically speaking, when the Federal Reserve has raised rates, that has not been good for the stock market in the short term. So it's created, that change has created stock market volatility, although the stock market has usually recovers from that volatility. But we do view it as basically like a tax, that the stock market is going to, or the economy is effectively has this additional tax put on by the Federal Reserve, and that's going to slow economic growth. It also could be a declining P ratio. We show that the P ratio is on a higher than historical average, not horribly so, but part of that is due to buyers and sellers. In other words, there's more buyers right now than sellers. If that changes, and if people for whatever reason decide that they are selling, that could certainly, in other words, even if earnings are the same, but just a market sentiment, that could change the price of stocks. And the last thing is something outside the kind of the unknown, specifically really outside the United States, that has what we call kind of some sort of contagion effect. And whether it's in Europe or in the Middle East or Asia. International, our feeling is that the quantitative easing is good for the countries. I don't think they're doing enough, personally. I think they need to do a lot more for the challenges that they have. We think that's good for European stocks. We think that we're not sure about the Japanese, what they're trying to do. I mean, it's very interesting to see they've had low rates for 20 years, no growth for 20 years, declining population. So they have some major demographic problems that right now I don't know how they'll ever get out of it, but certainly what they're doing to try and spur the economy is very interesting. We're watching that. And then emerging markets is also, we use emerging markets as a broad term. I would suggest that we may not be able to use that term anymore. And the reason I would suggest that is because some emerging markets are hurting pretty badly. We talk about Russia, and Brazil would be another one. And they're hurting because they are exporting nations of commodities. And those exports have dropped significantly. But there's other emerging markets that are net importers of oil. And so we're seeing a very different performance in those net importers. So India, for example, was up 20% in 2014. Why? Because just like here, when we're buying gas and it's significantly cheaper, same thing is happening over there. The drop in oil is very good for China, which is a net importer. So we're seeing different countries are doing different things. Exporters are being hurt. Net importers, commodity importers are actually being helped. So short term, it's a different story. Long term, we still think that there is the concept of a rise of a middle class and increase in consumers, but that may be quite a ways off. Interest rates, Again, on the short term, we think the Federal Reserve is going to raise rates. That's going to raise short-term rates. But long term, we think it's going to be the opposite. And we think interest rates are going to go down. Why? As I said earlier, because of the fact that other foreign countries or foreign companies are purchasing U.S. bonds. So that's one thing, is pushing interest rates down. The second thing is that the rise in the short-term rates by the Federal Reserve is a slowdown for the economy. If the economy slows down, that's reflected in long-term interest rates. And long-term interest rates are very closely correlated to inflation. So as inflation goes, so does long-term interest rates. Currently, inflation is expected, looking 10 years out, like 1.3%. That's basically in the marketplace. So expectations are that inflation is extremely low, and we think that that's really what's going to happen in the bond world. Dollar, I think that for whatever reason, I've really not seen this in the news all that much, but I really think this is probably the most underreported story for 2014. This is the dollar over 2014. And what you can see here is basically starting in, I don't know, June, July, we had a 10% rise in the dollar compared to other currencies. So in other words, part of the rise in oil was not only the fact that there was this demand-supply imbalance because of increased U.S. Production of oil. Part of it is also the fact that oil is denominated in dollars, and the dollar went up. And as the dollar goes up, other goods go down. So we think that's pretty significant in terms of what's happening to the dollar, and we expect that actually to continue, that the dollar is going to continue going up versus other currencies. Again, really good for international companies that are exporting specifically to the U.S. to have the rising dollar because it increases their exports. It makes goods cheaper for goods, for us, it makes it cheaper to import those goods. It does hurt U.S. commodity exporters, right, or U.S. exporters in the United States. So those countries that are exporting, it's not a good thing for. It also hurts U.S. companies that have sales abroad and when it gets translated into dollars. So in other words, Coca-Cola that's selling Coke outside the United States, it may seem like they're selling $500 worth of Coke, but actually when they convert it into U.S. dollars, it's like $450. In other words, when it's being translated, that amount they're basically losing due to the change in the dollar and how that's being recorded. So we're going to see some changes in characteristics in terms of what people are doing because of what's happening to the dollar and currencies. Okay, so what do we think? We think Europe's, I would say expect. So when it was written, we said expect. Today it is. Europeans have additional quantitative easing. We think, again, that's good for European stocks. U.S. dollar being, I think, the big story. And deflation being, again, a larger story than inflation. U.S. growing, after a plot horse, more like plow horse, right? Just kind of slowly growing, but continuing growing in the U.S. economy. More volatility in the markets and interest rates staying low. So how do we adjust for what are the things that we're looking at? Some things that we're looking at is staying away from the shorter end of the yield curve. In other words, looking at those investments that are short term and pulling back on those because we think the short term is going to rise and those are more dangerous, and staying more on the longer end of the yield curve. We're being careful about high yield. There are some concerns about high yield, specifically because of the fact that a lot of oil companies were funded in high yield. So we could see a dislocation in that market as we think that there are going to be some oil companies that are going to default on their high yield bonds, and that's, we think, is going to create some volatility. In general, we think stock market in the U.S. is just going to continue that slow growth, but it's not going to be as smooth of a ride as it has been the last several years. And internationally, we're looking at investments internationally that hedge out the currency risk. So in other words, getting that international exposure, but without necessarily taking on the currency risk and getting that hedged out. And those are some of the things that we're looking at in terms of how do we reposition the portfolio to take advantage of what we see as the different opportunities. Okay, so I think half an hour. So I'm here to answer if anyone has any questions. Yeah.
The Swiss changed their money.
Yeah.
What effect will that have on the world money, and why did they do that?
So the question is, the Swiss no longer pegged the Swiss franc to the euro. And the question is, why did they do what they did, and what effect is that going to have? So I think what happened is that basically, as the euro was deflating and the Swiss was trying to peg, they had a locked peg, and I think it was 1.2 Swiss francs to the euro. As they were trying to have that locked peg, they were in a situation of creating more Swiss francs and of buying more Swiss francs and buying more euros in order to keep the two pegged. And that was becoming an unsustainable. The central bank in Switzerland could no longer keep that going. So they had to break that relationship. That did send the Swiss franc soaring in value compared to the euro. That makes it harder, I think, for Swiss companies in terms of their competitiveness. So exporting, but I'm not sure that they do. I mean, I think let's put it this way. It's a lot more expensive today to buy a Swiss watch or a Swiss Army knife than it was 2 weeks ago. But I'm not sure really, I mean, their economy is a little bit more of a investment-based economy. And so I think they almost had no choice in terms of what they had to do. But I think it really speaks to what Europe is trying to do, what Europe feels like they need to do, which is really to deflate the euro in order to somehow make that economy somewhat more competitive, increase exports. But
do you think this is one of the first countries to start doing this? To me, it's like Germany is carrying France and Italy. It seems like the German economy is so much stronger than the prediction of.
Yeah, so the question is, well, so there's a question, I'm trying to rephrase the question just so we have that
Sure.
right. What we see who's controlling what's happening in Europe. And the fact that the economies within the European Union have very significant situations. So Germany being much more stable and also being a country that relies on exports for the relationship needs those European countries to stay within the European Union. At the same time, the policies that Germany in particular is dictating upon those countries, Greece being kind of the big case, is making life for the citizens in Greece really, really harsh. And so how they're going to work that out, I don't know. There's been talk again about Greece leaving the European Union. That certainly solves a lot of problems if you're Greece in terms of having more control over your future. Things that they can print their own currency. There's a lot of specific issues that they have going to an ATM in Greece, and what currency are you going to get? How does the pegging of currencies change over time? So there are a lot of actual issues on the ground that they would have to work through. So it's not as simple as saying, okay, we're ridiculous. It may be the right thing to do because of the fact we have an advantage that in the United States, right? If let's say North Dakota, right? If North Dakota all of a sudden has significant layoffs, right? What happens? The U.S. government gets involved and money starts shifting over to North Dakota. How? Through unemployment benefits, through Medicare, through Medicaid, through Social Security. There are other ways that the U.S. allows for transfer of assets, as well as movement of people. It's much easier in the United States. I mean, people are more mobile in the United States versus Europe. So it's a much harder situation to deal with this partial union that they have as compared to the United States. Okay, any other questions? Yes.
Seth, do you think that investment strategy, at least for the next year, is going to be less in manufacturing and more in idea-based companies, people that are creating and selling ideas rather than objects?
So the question is where do we think the growth, I think, I'm trying to rephrase it, where do we think the growth is going to be in the U.S. economy? Do you think it's going to be more ideas versus industry? I think in some respects what we're seeing is a growth more in healthcare in particular. And we think that is probably the area that we see a lot of growth. I think a lot of that has come from some of the Obamacare in terms of shifting of government dollars towards drug companies and insurance companies and healthcare related. So it's not necessarily ideas, but more service. We are 68% service related. So we think of those areas, those healthcare related areas. But that could include like biotech or, which I don't know, is that manufacturing or ideas? Some sort of combination. We think that those areas probably seem to be positioned today for stronger growth. Idea-wise, technology always seems to, I should say always, but seems to be a source of strength for the U.S. economy. Industry, certainly less so over the last, 30 years. And the rising U.S. dollar makes it harder for industry.
Seth, as you look at trends and make predictions, when we look at our economy and look at the government spending and the government giveaways and the government giving to other countries and the printing of money, how long can that house of cards stand until this whole thing goes down the tube?
Okay, so the question is, how long can the U.S. Sustain a deficit, basically, right?
Well,
Before
not
something
not
happens.
just sustain it, it's increasing. It's constantly increasing.
So, the answer is a really long time. And why do I say a really long time? First of all, because right now, I think the deficit is about 2.2%. The current deficit is 2.2%.
I think, as a matter of fact, it just went down.
Yeah. So as the deficit as a percentage of the entire economy of the U.S., the economy of the U.S. is gigantic. I heard from someone that the total economy of Russia, I've not checked this out to see if it's true, Steve, but what I was told was the economy of Russia, of the entire country, has the same domestic gross domestic product, GDP, kind of like economic engine as Los Angeles.
Well, they just said that California, if it was alone and split up, I think it was bigger than like Russia, Spain, and one other country combined.
Yeah, I mean,
It's 2.2 trillion in California alone.
our economy is just, it's really hard to imagine how big it is. So the fact that they have a deficit of 2% relative to the size of the economy is really relatively small. But I do think that part of the problems that we're having in a global nature are the level of debt globally. So in other words, not just the U.S. In other words, I do think U.S. growth below 3, right? We should have had a much faster growth rate coming out of this recession, but we didn't have that. I think that part of that is because of the debt overhang, whether it's by individuals or by governments. In terms of what the government spends it on, the government really spends their money on three things: Social Security, Medicare, defense. That's basically it. Everything else is relatively speaking, is peanuts compared to those three things. I'm not sure. Those things. I don't see the U.S. changing necessarily policy, no matter who's in charge, Republicans, Democrats, whatever. I don't think anyone wants to touch those three areas. And if anything, spending in them has increased under both Republican and Democratic presidents.
The unemployment is going down. Next July, minimum wages are going up. Because the unemployment is going down, manufacturers and businesses are competing for the smaller supply of workers. Aren't we going to have another, besides the minimum wage going up, won't we have another increase in wages?
So the question is, will we have an increase in wage growth due to minimum wages, a search for new workers?
And what effect will that have on the economy?
I don't know. I think it's relatively, my personal opinion is it's relatively small for the size of the economy in terms of the net impact. I'm not sure it's going to have a big impact. The things that we've been looking at in particular is actually, we think probably the larger impact, which is going to negatively affect wage growth, has been more industrialization, more robotics entering into kind of the production facilities, where, okay, so you're paying someone more money, but you have one person instead of three. And so we think that that is actually going to have the larger impact in terms of manufacturing and change, and what we see as changes in manufacturing. So, yeah, I hear what you're saying. I think it may affect what we'll call the lowest class in terms of strata. It may affect students in terms of minimum wages, but I'm not sure. I don't think we're going to really see net a really big change in the economy. Okay, so if you want to close. With that, we are going to be we'll be around if you have any questions that you want to ask. We, of course, appreciate your business and your interest, and we're happy to answer your questions. And we hope to continue doing things like this and sharing what we're thinking. Well, I guess one last thing I do want to add. So what else can people do in terms of what's happening? One thing that I'm doing right now is I'm refinancing my mortgage. So mortgage rates today, 30-year mortgage rates are at like 3.625 to 3.75. So pretty low from a historical standpoint. It has been this low before, but it was several years ago, and it's back at these rates. So even though the low rates are, they don't work for savers in terms of, right, like my 94-year-old great uncle is like, I can't get a CD anymore. But for other people, for people who have mortgages, that's one thing you can do. All right, thank you very much.